Very good morning, all. Welcome to today's session. People are joining with us. We are waiting for a few more people to join. The webinar is going to start very shortly. Kindly hold on for a few minutes. Thank you. Once again, welcome everyone. Thank you for joining us for today's webinar. I'm Divya from Relativity Management Solutions India Private Limited. I would like to introduce today's presenter, Mr. Akash. He is a successful young entrepreneur, speaker, innovator, and payroll expert who helps business leaders. He is the director at Relativity and he is known as a financial specialist for over 13 years now. He is also a frequent guest at events hosted by NHRD, NIPM, TI chapters, IIHR related to human resources, finance, taxation, shared services, and entrepreneurship. He has conducted more than 210 sessions offline and online, as well as Relativity's regular webinars every month. He is the host of Relativity Knowledge Series, a young YouTube channel to help HR professionals to be better, and the lead author of Relativity's blog. It's time to start our webinar. Let's start, and over to you, sir.
Thank you very much, Divya, for that quick introduction, and I hope I'm able to, all of you are able to hear me. I certainly hope that. Wonderful. Thank you. And most importantly, it is such a wonderful day. Just the start of the financial year, and we are just 2 weeks in. Both for the HR as well as finance, and particularly the business owners community, that is the entrepreneurs community. The start of the financial year is so very important. We do our budgeting, we do our planning, we set, probably we would have already set targets in the last month, and they're all in the happening for the current financial year. And with that bit of, a very good morning to all of you, and wonderful to see you all today. I know I can see some, known faces already. So welcome to you as well. So with that quick thing again, the last session worked out very well. I took a detour, like how Divya has mentioned. It's always a thing in me to be a little different, to deliver what we want to deliver a little differently, just instead of going with the usual presentation and all of that. So last week we had a quiz, and the same format I'm trying to use it this session as well. So I hope all of you have your fingers ready. We have quick 5 questions. Again, as I have mentioned to you earlier, all these questions are not straightforward questions at all. They may seem very simple and very easy and straightforward questions, but let me tell you that they are trick questions, because there is a lot of background that goes into the thought process of answering the questions. So with that quick thing, let's start with the first question of the day. Of course, before we start, let me also tell you that the whole program is designed around payroll, compliance, and taxation, because that is what we do. Relativity is fundamentally a payroll, taxation, and compliance company. So all of these questions are designed around one of these 3 areas, and it doesn't matter whether you are an individual, whether you are a HR head, HR director, HR manager, or finance head, finance director, finance manager. But all of these questions, I'm sure, will be relevant. So without much ado, let me start my first question of the day. And this is something that is interesting for all of us, right? And we have read it in the news. We have read it on newspapers. We have seen a lot of articles about it. What is the percentage of interest announced in March 2022 by the EPFO? And you have your options. Is it 8.1? Is it 8.5? Or no information yet? So please use the chat, and please go ahead and type your answers on the chat. As I told you earlier, that all of these seem very straightforward questions, but please take a minute or probably a few seconds before you actually answer. Okay, so I see a lot of 8.1. I see a lot of 8.1. Okay, good. Let it keep coming. 8.1, 8.1, 8.1. So everyone Few more, please. 8.1. Okay. So it seems that all of us have fallen to this trick. I told you it's a trick question. So let me show you what the response is. You know, the response is actually that there is no information yet. This 8.1% has been announced by the Central Board of Trustees. And once this is announced by the Central Board of Trustees, it is a recommendation they make to the Ministry of Finance. As per process, this recommendation goes to the Ministry of Finance. The Ministry of Finance has the powers to either accept the recommendation of 8.1 or continue the existing rate of 8.5. After the acceptance of the Ministry of Finance, then the Ministry of Labor, which is heading or which is the ministry under which the Central Board of the Provident Fund comes under. So they will actually send a letter to the Employees Provident Fund Organization. The letter is sent to the Chief Commissioner of Provident Fund. And once the Chief Commissioner receives this letter from the Ministry of Finance, only then the rate is notified by the EPFO. Right? Until then, the rate is not notified by the EPFO. Now, you may ask, no, but there is so much widespread information that 8.1 is going to be the rate. Yes, I'll tell you what the question is. What is the percentage of interest announced in March 2022? The question is by the EPFO. So the EPFO hasn't announced it yet. It is the Central Board of Trustees who have made a recommendation of 8.1. It can be accepted, it cannot be accepted. I mean, it's only up to the Ministry of Finance, but it logically seems that the Ministry of Finance will accept this 8.1 primarily because, you know, the MOF themselves have been asking the EPFO or the Central Board of Trustees to reduce the rates and make them on par with the small savings scheme. But the EPFO hasn't notified it yet. And that is why if you see all the calculations still happen on 8.5%, they don't happen on 8.1%. So you may ask, okay, what kind of calculations happen? So let's say somebody is withdrawing their provident fund, right? While at the time of withdrawal, the interest has to be calculated. This is still calculated at 8.5% until the EPFO notifies it. And usually this notification comes sometime in the month of September or October. And that is when we actually see on our PF passbooks that the interest of 8.1 or whatever is the rate that has been accepted by the Ministry of Finance and notified by the EPFO is actually calculated and deposited into our PF account. Right. So this is the procedure. Anybody who is surprised with this procedure? While you type out your responses, another area where 8.5 is still currently used is, we spoke about this even during our last webinar, that we are supposed to calculate perquisites on PF, NPS and superannuation fund exemption over 7.5 lakhs. So even for this, the rate of interest on the PF balances is used at 8.5 only, not 8.1, because only a notification is a legal document. So I hope you know this process is something that now you are aware. You may also, few of them have also asked me, okay, how many times has Ministry of Finance not accepted the recommendations of Central Board of Trustees? So I can tell you a couple of times Ministry of Finance has not accepted the Central Board of Trustees recommendations. Not in the recent past, but at least I know for the fact in 2011, 2012, they did not accept. And that I believe was an election year. So people were, the ministry was batting for a higher rate. In 2006 and 2007 also, Ministry of Finance did not accept the recommendation. And that is what it is. As Pawan has rightly mentioned, yes, it is proposed for financial year 21-22, but whether it is going to be what 8.1% is something that we have to wait until the EPFO notifies it. So until such time, for all the time, we'll have to look at EPFO's notifications. Okay, so question number 2. The Income Tax Act has decided, and I'm sure that this is 1 year old story, but certain clarifications have come very recently. So I thought it would be a good idea to talk about it. So the Income Tax Act has decided to tax interest on contributions in excess of 2.5 lakhs. We all know that, right? Any personal contribution, employees contribution in excess of 2.5 lakhs, the interest on that excess contribution will be taxed. Now, the question that a lot of us had was, will the interest on closing balance as on 31/3/2021 be subject to such tax or TDS? And here are the options: yes or no. Please, there is chat. So yeah, I see a lot of no's out there. Okay. So there is somebody who says yes. Okay, let's see what few of them say. Few more. Okay, no. A lot of them say no. So all of you who say no believe that the closing balance as on 31/3/2021, which is the previous financial year, on that accumulated balance, there will not be interest. That there will not be tax on the interest earned. That is what all of you believe. Okay, so I think most of our responses have come, and let us see what the answer is. So this is the recent clarification that came out just a couple of days back. In fact, it came out on the 6th of April. As you can see under 2 and item number A, non-taxable contribution shall be the aggregate of the following. So closing balance in the account as on the 31st day of March 2021, 100% is not taxable. So all of you who said no, you have the right answer. Do have a grip on your scores, because we are also going to look at who has the highest number of the right answers. Apart from the closing balances, what other balances are non-taxable? So as you can see on A, sub item 2, any contribution made by the employee in the account during the year 21/22 and subsequent years, which is not included in the taxable contribution account. So what is this taxable contribution account? So the minute we start making contributions in excess of 2.5 lakhs, that until 2.5 lakhs goes into a non-taxable contribution account, and any sum in excess of 2.5 lakh now goes into a taxable contribution account. So as I had mentioned during the last session, that we will now have 2 different passbooks. One passbook is the non-taxable contribution passbook, which will contain all of these, 1, 2, 3 and everything. And then there will be a taxable passbook where, whenever we have a contribution in excess of 2.5 lakhs, it will go and sit in the taxable part. And that only will be taxed. And the interest on that, not that is going to be taxed, the interest on that is going to be taxed. And then probably there is, there is definitely TDS that is going to be applicable at the rate of 10%. And that is why it is very important that we declare or we map our PAN numbers on the PF accounts, so that a higher rate of deduction at 20% is not applicable to us. When we map our PAN number, the rate is only at 10%. Great. Okay. So let's, any questions here, please use the chat in detail. Tina has asked, can you explain this in detail? Okay. So Tina, I'll take a quick minute to explain this in detail for your benefit as well as for everybody else's benefit. So contributions to Provident Fund have 2 components. One is the employer's contribution and the other one is the employee's contribution. The employer's contribution, there is already a cap of 7.5 lakhs, and any contribution in excess of 7.5 lakhs is taxed at the interest level, as well as the excess of the contribution is also taxed on the perquisite level. This, what we are talking about, is the employee's contribution. So sometimes some of the organizations follow a flat 1800 rupees contribution to the employee's account. In that case, this is not applicable at all. This will be applicable if you are calculating the employee's contribution at the rate of 12% of basic, right? So if the basic is 25,000, then 12% of that 25,000 is approximately about 3,000 approximately. And 3,000 into 12 is 36,000, which is less than 2.5 lakhs. So until 2.5 lakhs of the employee's contribution is not taxed at all. The interest on employee's contribution is not taxed. Any additional contribution exceeding 2.5 lakhs will be taxed. Right. So I hope it is so there are a couple of questions. Is it for every year 2.5 lakhs? Yes, it is for every year 2.5 lakhs, correct. Is VPF also considered for this 2.5 lakhs limit? It is our understanding that VPF is also considered for the 2.5 lakhs limit. Yes. The ceiling of 2.5 lakhs is total contribution or employees contribution. So that this 2.5 lakhs is only on the employees part of the contribution, not the total part of the contribution. Okay, so there are a lot of questions. Let me take them, because it's good that we have the questions here. What is the VPF limit for employees? So Pawan, there is actually, I don't think there is any VPF limit for employees, right? You can the 12% is the mandatory EPF deduction, and you can contribute as much as you want. Of course, there are some income tax benefit limitations that will be applicable. So the remaining is about 88%. Yeah, Balakrishnan has mentioned that. So 12% is the employee's contribution, mandatory, and up to 88% you can go for the VPF contribution. So that makes a total of 100%. So you can't contribute more than that. Okay, is there any tax on employer's contribution also? No, there is no tax on employer's contribution as of now. It is only if the employer's contribution exceeds 7.5 lakhs. That is a totally different conversation. We have, the PF perk calculation, and that is how it is taxed, but not on this particular item that I'm talking about. Yeah, thank you for your response as well, Balakrishnan. Helps. Wonderful. Okay, so with that, let's move to our next question quickly. This is also something related to taxation again. So we all know that since February 2021, this new rule was implemented. What this new rule says is that ULIPs, if we are contributing more than 2.5 lakhs, then the ULIPs will be taxable, and the exemption under section 10 of 10D is not applicable, because the government found out that there is a loophole that they are taxing. They are taxing everything, right? They're taxing every damn thing. We earlier had a triple E regime. I would like to take a minute and talk about this regime. This is very important. So what is a triple E taxation regime? Triple E taxation regime means exempt, which means the income, the money that I receive is exempt from tax. The investment that I do is exempt from tax, and the interest or the growth that I receive from that investment is also exempted from tax, right? So we earlier were in a triple E regime. It is called as a triple E regime. So lot of such incomes were exempted. Like, for example, dividend income, right? So it is exempt. It was exempt until now. Since the last 2 years, we see that dividend income is now taxable at our own tax rates. So the Employees Provident Fund was also exempted. We never had any taxation on Employees Provident Fund. The contributions were exempt under Section 80C. The money that we get back as maturity or as withdrawal, if we fulfill certain conditions, is also not taxable in our hands. And the interest earned on EPF balances was also not taxed on our hands. So that was a classic case of a triple E instrument. And if you ask me, EPF, I think, was the last triple E instrument. Now we have absolutely no triple E instrument at all. Now it is, most of them are either ETT, that is exempt taxable, or EET, exempt taxable. Provident Fund has now moved from a triple E regime instrument to a EET regime instrument, that is exempt taxable. ULIPs, insurance policies, all of these were under EEE regime. The money that I invested in a insurance policy was exempt under Section 80C. The growth or the interest that I received from it was also exempt. And then finally, the maturity proceeds were also exempt under Section 10 of 10D. Right? So when all of this is exempted, it made a classic case of triple E regime. But now that list has been reduced. Now we have very few people on, I mean, the ULIPs are now not on the triple E regime instrument. Now they have been made under the EET instrument, which means that exemption is only applicable until a certain, until a certain limit, and beyond that, it is not going to be applicable. Yes. So with that, okay. So the question is, ULIPs were non-taxable under Section 10 of 10D until 01/02/2021. Which of this is false? The options are coming on your screen. Oops. Okay. I hope I didn't jump the gun and then you didn't see the answer. So we have three options here. You don't have to tell me what is true. You have to tell me what is false. ULIPs taken before the 1st of February 2021 remain non-taxable irrespective of the premium paid or the maturity value. Option number B is ULIPs taken on or after 2021 February will be taxable irrespective of the premium paid. And option number C is ULIPs taken on or after 01/02/2021 will be taxable if the total premium paid is exceeding rupees 2,50,000 per annum. So what do you think are the answers? It's important, right? Because whether, irrespective of whether it is an HR matter, I think as individuals itself, we do a lot of investments in insurance policies. So it's important that we know. Okay, B is false. Okay, so I think everybody is mentioning false, right? Okay, good. Neha, Balakrishnan, most of you say B is false. Okay, what else? I mean, there are 81 participants here. What about the rest? Just get onto the flow, right? I mean, there is no harm. There is nothing that is going to happen, even if you say A or C, or it's just a way of getting to know something in a more interactive manner. That is all that we are trying to do here. Okay, B is false. B is false. Most of you say that B is false. And to all of you who have said B is false, you are absolutely right. The limitation is in the total premium paid in excess of 2,50,000 and not irrespective of the premium paid. So absolutely B is the false item. But I think the devil is in the details, right? So I encourage all of you to have a look at this circular number 2 of 2022. It's there on the Income Tax Department's website. And this circular was much awaited circular by a lot of industry participants, a lot of financial institutions, including insurance companies, because when the department said that the total premium paid exceeding 2.5 lakhs is, they cannot claim exemption under section 10 of 10D. And if I have three different policies, right? First policy, my premium paid is 1 lakh. Second policy, my premium paid is another 1 lakh. And the third, my premium paid is actually 1 lakh. So is it that for all of these three policies, I cannot take section 10 of 10D exemption, or is it that only I can take the section 10 of 10D exemption for the first and second, but not for the third? What happens if I surrender the policy? What happens if I make a partial withdrawal out of the policy? So there were a lot of questions which were unanswered. And the insurance companies were also clueless. So the income tax department rightly, it's always a practice. I hope there is nobody from the income tax department on this side, but it is a practice that first they introduce the law and then they give all the clarifications, and that too not immediately. Okay, after a couple of months, when we are done breaking our heads and we have started following a path, a clarification comes which is contradictory to the path that we have started following. I hope there is nobody from that department, but if there is somebody, boss, this is the truth. I'm speaking on behalf of everybody else. Okay, and you know it for all the good reasons. So there was so much confusion in the industry, but with this clarification, I think a lot of that confusion has come to rest. Can you please share the link of that circular? Yes, Balakrishnan, we'll definitely share the link of that circular, 100%. Okay, so moving on to the next question, fingers on your phone. And yes, now this is a controversial question, okay? Even if you're not a finance guy, even if you're on the HR side, I think this is important to you, because it is a temporary situation that we are dealing with COVID, and we have all this work from home stuff and all, but this is definitely going to go away. We are already moving into hybrid work models, and in all likeliness, we will scrap the hybrid work models after we find that it is not working, or probably, for a few companies or for many companies, it is working, so they'll continue. But for those companies who are providing transport facility on behalf of the employer to the employee, I mean, most of the companies provide, right? If you're in the BPO, if you're in the KPO, if you're in the ITES sector, this is it is not an exception, but it is a norm. It is expected. Hey, you don't have transport facility is what people ask. Yeah. So what is it? What do you think? And my inspiration of having this question today is because there is an AAR ruling on, not AA, triple AR ruling on this topic, and that's why I'm having this question. Is GST applicable on transport facility provided by the employer to the employee? That is the question. Okay, let's see what the answers are. No, yes, no, yes. Okay. Yeah, Neela says yes, only if the cost is recovered from the employees. Okay, that's a point to be considered. Fine. Few of them say no, yes, so no, it's free. Okay. Yes, actually it is free. So there are two models. One model is where you actually recover the cost from the employee, or the nominal cost. Usually transport facility, when provided by the employer, is subsidized. We don't recover the actual costs most of the times. So it is either you recover a nominal cost, or you provide it totally free of cost. You don't recover any money at all. So no, yes. So we have a mixed response, right? No, yes, no. Yes, only if the cost is recovered. Anybody here who have actually started recovering, for those who have said yes, do you provide transport facilities, and are you actually recovering GST on that transport facility? Is there anybody like that on this forum? I don't know. Maybe there is, maybe there is not. Nevertheless, so I think we all have a mixed response to this, right? And it's not as clear yet. Neela not started yet. Okay, wonderful. So I think then today's session will be a blessing in disguise for you, Neela, because before you start, I think another Pandora's box is going to open. Now, a word of caution here is that this advanced authorities ruling is only binding to the company who has asked these questions. It is not binding to you and me, right? But as finance guys, or as at least as finance guys, we take a lot of inspiration from these rulings, because once this ruling comes out, right, every officer refers to this ruling. See, this it is what AAR has ruled, or the affiliate AAR has ruled, and that is why you should do this. So it becomes a norm rather than an option. So we have to be aware and then appropriately chart down steps. Okay, so this is what the ruling said. It's on your screens. The answer is yes, we have to recover. And that is irrespective of whether it is free or it is, you get a nominal recovery. So what it has said is that the transport facility is not a contractual obligation between an employer and an employee on account of employment, because there was a circular, I think in 2017, when GST was introduced, that anything contractually obligated between the employer and employee is not a GST accessible service. That was a circular to this effect. But what the AAR has ruled is that this is not a contractual obligation. You need not provide this. You are providing this because you want to provide a facility to the employee. It is not mandated by the law. So if that is the case, then it is not exempt from GST. It is actually taxable under the GST. Now, many of you can, even I had this natural question. Okay, so when I don't recover any money from the employee, how do I tax it, right? How do I actually have 18% on the, how can I have 18% on zero? Zero is the money that I'm recovering from the employee if it is free of cost. So anything multiplied by zero is zero. We all know that. But then the the affiliate advanced authority ruling has gone one step ahead and has mentioned that how to value the service, right? Whether you are not doing any recovery or whether you are doing a nominal recovery does not matter, but the valuation of the service that you are providing as transport should be done in accordance with section 15 of the CGS. Here, HGST is Haryana GST Act, because this particular case belongs to Haryana. So just substitute it with that state's SGST Act. And in summary, the ruling says taxable value greater than 50,000 per annum is taxable, and GST is applicable on it. If the valuation of service per annum is not exceeding 50,000, then it is still free. I mean, it is still not accessible to GST. It will continue to be not accessible to GST and not chargeable to GST. But in case it is actually exceeding 50,000 rupees per annum, then it is actually accessible to GST. So it is what it is. Whether this is binding on your company or in the state that you are in, if you are outside of Haryana, no. AAR rulings are not binding on anybody apart from the petitioners, right? But I think it is important for us to note that such rulings set a precedent that we have to do something. Is it total amount or employee wise? Per employee. It is the 50,000 per annum is per employee. calculated for that specific employee. So what does it mean, right? If the valuation of the service is exceeding, I think 4,000 into 12 is 48. So 4,166 rupees per month for that employee, then we'll have to deduct, we'll have to also charge GST and recover GST from the employee. If it is less than 4,166 rupees, then there is no need for us to actually recover GST. This is what in summary the ruling is. Anybody has had a different experience? Any of your, see, I always keep mentioning that it is important as much as I can share knowledge of whatever I know. It is also important that we share cross knowledge. That is something that you have done. You can share it on the forum, beneficial to everyone else. So anybody who has any experience in this area, what you guys did, what your auditors, statutory auditors advised you, did you approach the advance ruling authority, the authority for advance ruling, and then did you get a different kind of an opinion? Is if there is somebody of that sort on this forum, please do mention and share your experience with us, or probably one of your ex-employers or something that you know. I'd also like to recognize, I got this chit, so my thing is only limited to this chit. Maybe our people have missed some of you, but Aarti, Ajay, Mr. Sornamani, Balakrishna, Balamurgan, Mamta, Purushothaman, Saumya, all of you have been regular attendees for our webinars and workshops. Thank you. We recognize your presence and we appreciate it. We also appreciate your contribution and your participation. Few of our clients are also here. So, Anadraj is there, Puvili is there from Payoda, and Sarvanan is also there. So nice to see few of our clients also participating. Thank you for participating today, all of you, and the rest of you. If I missed somebody, please just put a hi message on the chat. Happy to say hello to you. Any of you know me, I've not mentioned your name or anything. Please, happy to say hi. Neha, I think you were there last time. Neha, is that the same Neha? I believe so. Yes, go ahead. We'll definitely no. Okay, no problem. Yes, wonderful. So there are a couple of questions that are coming up. Please let the questions come, and we'll definitely take it as soon as we finish this course. I think no, there is one more question. Okay. Hey. Trick question again. Okay, trick question again. Whether section 115 BAC rates, what is 115 BAC? Let me make it simple to all of you. It is the old tax regime versus the new tax regime. So 115 BAC means the new tax regime where employees forego a lot of their deductions and they opt for a different tax rate altogether. So the question is whether the old tax regime rates or 115 BAC rates are applicable on the income from business or profession, or the rates are only applicable to salary income. Now that is the question I have, and please go ahead. You have your fingers and only salary income. Okay. Let the answers come. Okay. Please. So as I told you, it is a trick question. None of my questions are straightforward. Okay. It's just you ask my team and they say if Akash asks a question, we should take 5 minutes to think and answer, because his questions are never straightforward. And I believe, the real learning is in that. The real learning is not in asking questions which are easy to answer. The real learning is into the detail. That's what I say. The devil is in the detail. Yes, while you guys are answering, I really want you guys to answer. If you are in HR or finance, this is a question that you should definitely know. Okay, so while you're actually penning down your responses or trying to find, some of the last attendees, last seminar webinars attendees, I had an opportunity to meet them separately for a salary restructuring workshop that we did, and some of them said, Akash, he admitted the minute you ask questions, I went on Google, I searched, and I put the answers. That's also absolutely fine. As long as you're involved, it's absolutely fine. It's an open book test. Who doesn't like an open book test? Yeah. Okay, so can you elaborate? There is one question. Can you elaborate about IWPF contributions statutory limit? Sure. So for IW, that is for International Workers Fund, the PF contribution is 12% on gross. I think I am right. Arun, can you confirm if I am right? For international workers, it is 12% on gross, not 12% on basic. And you cannot even limit it to 1800. Arun, I hope you are here. Please confirm. Yes. Neha, please go ahead with your query, or if you have already there. Okay, no, hi, yes, thank you, Saravanan. Neha, what are the tax exempted components and monthly limits? That's quite a quite a big list, or probably a small tiny list nowadays. It depends on how you see it, but there are a lot of components, and is my team Divya, is there a blog that we have on this? What are the tax exempted components and their monthly limits? If there is, can you please share the link to Neha so that she can have a look at it. But apart from that, there are partial, just for your benefit, Neha, there are partially taxable components, and then there are non-taxable components also. Both of these are there, and then Divya will share that list. We have a blog article, I remember, or otherwise there is also an exhaustive list on the Income Tax Department's own website. Divya will share that link if that's required. Balamurugan, thanks a ton. Thank you. Yes, reignite unknown gray areas. Absolutely. My hair has already started graying. Bala, absolutely right. Deepa from SWF Technologies would like to have inputs on payroll structure. That is a workshop question. Deepa, I encourage you to reach out to Naveen. Naveen, please reach out to Deepa. We have regular salary restructuring workshops. We just finished 2 of them last month. So, if you would like to join one of the upcoming workshops, Deepa, most welcome. That's quite an elaborate question. I mean, I can't answer it just like that. The only salary income. Okay, so only salary income. A lot of them say only salary income. Geeta, GST is applicable on notice period recovery. Yes. It's a good question. Let me take that later. And I think I also spoke once about it. Yes, 12% on gross salary. Yeah, thanks. Okay, so I think after this, there are a lot of other questions. So let me finish this. Question number 5, the answer is, I don't have the music effect that you get with Amitabh Bachchan, because that is KBC and this is RMS, right? So no hot seat concept for now. So the answer is that 115 BAC is not only applicable on salary income, but it is also applicable on income from house property and income from business or profession. All of you who have said only salary income, you've lost a point. Okay, so some new joiners. So this question was asked to me by a fellow payroll professional in the industry. So the context of the question is, can new joinees, right, who have forgot to declare, and the Act mandates that we should only collect declaration once. The employees are not allowed to change it later. This is what the Act also says. So some new joinees who haven't declared, but they want to choose new tax regime, what can they do? So by default, it is always the old tax regime. If nobody declares or if nobody, if nobody accepts it, then it's the old tax regime. But then if they declare that they want a new tax regime, then we are bound to calculate taxes as per the new tax regime, and then give them Form 16 to that effect. But then the option that is available for such employees is that at the time of filing, they also have this option again at the time of filing, whether they want to continue with the old tax regime or they want to change it to new tax regime and either pay additional tax or take a tax refund based on their revised calculations. So this is based on their previous year choice, as well as there are certain restrictions in terms of opt-out options available. So those restrictions apply generally to everyone. So this is the answer. As I told you, the devil is in the details. Okay, guys, we just completed 5 questions. Now, who have got this course? Who've got 4 out of 5 or 5 out of 5? 4 out of 5 and 5 out of 5. The high scorers. Okay, Ajay Kothari, wonderful. Yeah, that's. Can I take the credit, Ajay? You have been attending our webinars regularly, so I believe it is our after effect also. Sorry, I'm taking the credit, but then just in a simple sense. Anyway, 2, 3. Oh, come on, you're already tired. And we still have about 10-15 minutes to go. I think the next time, what do you want me to do? Make it a little more simpler or make it a little more complex? What do you want me to do the next time? I mean, we have this every second Wednesday. Yeah, every second Wednesday of every month. Yes, so you want me to make this complicated, a little more difficult, a little more thought process, a little more in depth, or do you want me to make it a little more easier, simpler? What do you guys want? Okay, this is perfect. Okay, complex. Somebody wants it more complex, simpler. Okay, both complex and simpler. Okay, Sornamani sir, I think then we have to have Group A and Group B. Group A is simple, and Group B is probably complex, and then see how it actually pans out, so that employees can understand. Sure. Simple. Yeah, we'll try to have. So what I'll do, what I'll try to do next time is, instead of having just 5 questions, maybe I'll cut my chatter. I know I speak a lot. I'll cut that down, and I'll have 2 or 3 more questions. We'll probably have a mix of 4 simple questions and 4 complicated questions, so that it's all there. Yes, I have attended the first. Okay, sure. Most so there are a couple of questions that we have. Let's quickly take the questions. So I am going back to the questions. How can we make employee-friendly CTC breakup more tax-exempted components to avail? So a quick answer to this, Neha, is that please analyze. There are 3 types of pay heads that you have. One is the fully taxable pay heads. The second is the partially taxable pay heads, and the third are the fully exempt pay heads. Right? So please analyze, do you have more of the fully taxable pay heads and very few of the partially taxable and fully exempt pay heads? If your fully taxable pay heads are many, and if your partially and fully exempt pay heads are very few, then I think it is necessary for you to bring this choice up, so that you can have a CTC where you can actually give the power of tax saving or tax optimization to the employees, right? So that's something that you can think of. Employer and employee gets tricky adjustments for transport facility Okay, so before I go there, I think there is one more update or two more updates that I wanted to share. Yes, long awaited are four labor codes. They are not going to come up at least before the end of June, right? We thought they'll come in last October, then it moved to this April. Now it is going to move beyond June for certain, maybe July, maybe October as well. I don't know, because 7 states are yet to frame rules under these labor codes. So after these states frame their rules, only then we can look at it. The update number two, we spoke about this last time. I'm again talking about it this time because it is very important. All of you guys, are responsible either directly or indirectly for the annual year-end compliance. And the result of that year-end compliance is an accurate Form 16 to your employees. Part A and Part B is generated from traces. The Part A has data from all the quarter Annexure 1, and Part B has data from Annexure 2 of Q4. Please do remember that when an employee is not in Annexure 2, you will not get Part B. You will only get Part A, which means that if you have had exit employees during the financial year, then you should include them in Annexure 2. It should not be only limited to the Q4 live employees. Very, very important. And then Q1 to Q4 Annexure 1 TDS data has to match with the tax deducted in Annexure 2. If this does not happen, what will happen is the employer will get a demand, point number one, and point number two is that the Form 16 Part A and Part B will not match for the employee. And if the employee doesn't know that it is not matching and he still uses it to file his tax returns, then the employee will get a notice and it will bite their back, our back, everybody's back. Right? So be careful about that. The tax payment due date is 30th April. Q4 returns have to be filed by 31st May. I'm only talking about the salary returns, and Form 16, the due date is 15th June. Now, when I said this, yeah, there is always an extension. I should tell you that this time there, in all probabilities, may not be any extension at all. We have seen CBDT taking a very hard stand, when they had extended the income tax rate, so many due dates for such long time, even upon the interference, not the interference, even upon the request of certain high courts, the CBDT said that they are not going to extend any due dates and enough time was provided. So having said that, I do not expect any extension for any of these because life is almost back to normal. The only thing that we don't do is returning to office, but everything else is back to normal. So these are the dates, and I think we should stick there. Before I start taking your questions, I would like to highlight some facts for those who are new today. We are 13 years and young. We have 153 clients and counting. We process about 1 million transactions every quarter, 99.5% accuracy rates. We are present in 16 cities and we have about 500,000 Form 16s issued. So the volume and the depth of this data should tell you that we are really what we say we are, that we are the compliance experts in the areas of payroll, compliance, and taxation. Should you have any requirements in any of these areas, please feel free to reach out to us. This slide is mandatory because otherwise then my business development department will not allow me to take webinars. And I hope they are listening or not. Okay. So, okay, now I'm back to questions. Back to questions. I'm leaving the screen as it is, but I'm back to questions. In case where there is free time, I think a lot of questions are already answered, is it? Good. So there is answer instead of from me to you guys. There is an answer from you guys to you guys. So that's a good thing. Knowledgeable and simpler I've attended. Okay, little complex. Need inputs on gratuity too. Okay, we spoke about gratuity in detail last webinar because there was a change. Neela, even I want to join for the salary restructuring workshop. Sure, sure. I'm sure Naveen has made a note of it. If you guys, I don't know, I mean, what questions you want me to answer or what you don't want me to answer. So in case there are any unanswered questions, please put them on the chat box. I will definitely take them now. I'm going to be around. And okay, so while you put your questions, I am going to run a quick poll, please. It helps me, or it helps relativity do better. It helps it helps us, design these kind of programs better, bring more value to you. So I request all of you to take a quick, I don't think it will even take 30 seconds for you to please answer the feedback questions and the sales poll. Those of you who want, anything related to salary structuring, Naveen is definitely making a note, and he will definitely reach out to you when we have the next workshop. Yes, can we have recordings of your older webinars? Absolutely, Tina, we do have. So I think they are there on our, Divya, are they there on our YouTube channel? If they're there on our YouTube channel, would you share the link of, it's already there. Yes, so you Tina, you can see that we have this YouTube link, and you can see all our recordings there. All of these are live streamed. You will find tons and tons of sessions that we do. A blog is also something very interesting, right? On the blog, we go into a little more of in-depth analysis of certain aspects. So please feel free to visit our blog as well. Since we are doing, okay, there is a question and I love to take it. Since we are doing work from home, suppose employee is staying in non-metro city, how his HRA will be calculated on 40% or 50%? So Neha, I think what you are meaning to say is you have received a rent receipt, and on the rent receipt, the city, if it is a metro city on the rent receipt, then it's okay, no, 50%. But if it is a non-metro city, then it is 40%. No, but I don't think that's the question, right? You are talking about HRA entitlement, which you would have already decided when you are designing the salary structure. So there is very little that you can do about it now, provided, because you have already paid that allowance out. But if you are referring to the rent receipt that you have received, it is based on the city that they have mentioned on that rent receipt. Okay. Can employee claim HRA and home loan interest and principal staying in the same city? Yes, they can, provided there is a 50 kilometers distance between their rented property and their self-occupied property. This is there in the act itself, 50 kilometers. Okay, is TN government ready with draft rules? I think for two they are, and for the other two they are not. What's the latest, Arun? Mr. Swarnamani's question, can you please answer? Is TN ready? Okay, Neha says, I'm asking about salary structure. So when you're talking about salary structure, Neha, it's either 40 or 50%, right? You can give anything. You can give 40 or you can give 50. I would recommend that you give 50%, because on the salary structure, there is no law which prohibits you from giving 50%. It is only on the exemption that this 40%, if it is a non-metro, and 50% if it is a metro, is applicable. but there is really no law which says that in the salary structure itself, you have to give only 40% if they are living in a non-metro city and 50% if they are living in a metro city. What is the turnover of any company? Sorry, I didn't get that question. What is the turnover of any company? Percentage age of HRA in salary structure component. Anything between 40 to 50% works, Tanuj. Yes, 40%. Yeah, that is right. Okay, wonderful. So I think, what is the definition of turnover? How do we calculate? Are you trying to refer to the bonus, Mamta? I think you are trying to refer to the bonus. What is the definition of turnover? How do we calculate? Mamta, turnover is actually the sales. You know, the top line, the revenue that the company does. That is what is called as turnover. Are you speaking about the turnover attrition rate? I'm not very sure. But then on financial, yeah, both are the same. Yes. The top line is called as, the sales or the revenue or the turnover. All of these three are used interchangeably, and then they are the same. Correct. Yes. Okay. So I'm going to hang on for another 5 minutes, but I would like to, there are a few people who may want to move. I hope you have taken your time to give us your feedback. And before you guys leave, I would like to say thank you very much for joining today's session. It was a quick one. I didn't know that it's already 60 minutes, 5 minutes past the 60 minutes time. So thank you very much for joining. Keep coming. We hope that you get a lot of value, and probably sometime we should also try a meetup. Okay. Why should only, there are a lot of meetups that keep happening. Even we used to have meetups of our participants, regular participants. I think we have met twice in Bangalore, twice in Chennai, twice in Coimbatore as a mini conference. So obviously, we should meet up now that COVID is going down and we are getting back to normalcy. Once again, thank you everyone for participating, for lending your fingers for the quiz, and for lending your ears to my chatter. Have a wonderful week ahead, all of you. Okay, so I'm back to the questions. Durga, need inputs on Equal Remuneration Act and how is the form filled? Please consider this for one of your sessions. The Equal Remuneration Act and how is the form filled? You are talking about the form that we have to fill for the Equal Remuneration Act. Sure, Durga. Arun can make a note of it. Arun, is the leader of compliance, so I'm sure he'll definitely make a note of it. Thank you, Durga, for your inputs. But due to pandemic, people are working from home. Example, employee work location is Bangalore, but claiming rent. Yes. So we can provide a HRA exemption. You're absolutely right. Whatever is the location that is there on the rent receipt, Bala, is what we are trying to, what we are trying to provide. Absolutely right. Sure, that's a great idea. Okay, thank you. Thank you, everyone. What is the right time to make the salary structure? Sornamani sir, the right time to make a salary structure is usually either at the beginning of the financial year or at least at the beginning of the quarter. So let's say if we have missed a quarter, let's say if you have missed Q1, then at least Q2. If you have missed Q2, then at least Q3. But the best is Q1. At the beginning of the financial year, you just do it. But it actually doesn't stop you from doing it in the middle. Just that if you wait for the quarter to end and then introduce it, the records are much more cleaner. It's more of a best practice. Yes. When is the new wage code expected? Jignesh, I don't think it is expected at least until June. So we don't know what the situation is. there are about 6 or 7 states yet to form the rules. So we'll have to wait for them to draft the rules, and then the center will announce a date for its implementation. It could be June, it could be, it's definitely not June. It could be July, or it could be even October. Is it not better to make the salary structure after the wage code is implemented? So I think as far as the wage code is concerned, for salary structure, all information is available. The only thing that we are waiting is for the rules. But for designing your salary structure, all information with respect to the new labor laws and the new wage code is already available. So that definitely 100% we should align any salary structure changes to the new wage codes. But even then, it's a big leap. There are certain clarifications still that we are yet to receive. That is, the labor department says 50% should be basic, whatever we promise to the employee. So they are now planning to have a deferment period. So, first year you hit this target, second year you hit that target, and the third year onwards, at least you start making it 50%. So there are some options that labor codes are going to bring in. But given that labor codes, are to be implemented from the last 1.5 years, it's just a running ball. I really don't know when they are going to be implemented for sure. Even October 2022 is a wild guess. Only progress will say what's going to happen. And then if we enter 2023, 2024, we again have elections and all of that. So no idea. Under the Payment of Bonus Act, what is the due date of annual return? Arun, can you answer this question, please? Under the Payment of Bonus Act Central, what is the due date of the annual return? Or probably end of November or 31st Jan. Okay. So, yes. Okay. I think the questions have dried down. So let's have your questions for the next session. Thank you very much. Have a wonderful week ahead. Take care. Tata. Bye-bye. Sure. Always.